Hello, everybody. This is Daniel Torres speaking. Recorded this session with Peter and Bryan from the CPG Guys. The CPG Guys are our sister podcast at the other side of the Atlantic. They speak with leaders in the consumer goods industry, especially in the US. So I had them with me live on LinkedIn, actually, to speak about the results of consumer goods companies, especially in the foods space and the personal and home care space. At the beginning of the recording, we had some issues with echo, so I'll ask you for a bit of patience at the beginning, or if not, you can just fast forward to around minute 3 or 4 where the issues were solved. Enjoy the session and have a great day. Any feedback will be welcome. Cheers. Bye. Hello, everybody. Good morning, good afternoon, good night, wherever you are. This is Daniel Torres, host of the FMCG Guys podcast for a special LinkedIn Live, which I hadn't done in a while, actually, and accompanied by my peers at the other side of the Atlantic, PBSB and Bryan Gildenberg. Hi, guys.
Hey, Daniel.
Daniel, how you doing?
Not too bad, not too bad. It's a nice time to be in Barcelona. Those things, actually, a lot of people are already.
Daniel, identify the times where it's not nice to be in Barcelona. List them. I itemize those. I'm curious.
July is bad. If you want the specific time, July is bad. Full of tourists.
Okay.
So there you
go. The world's smallest violin is playing for you, Daniel, as we say on our side of the pond.
Yeah, there you go. So today I'm very fortunate to have these two experts in the industry to go over the latest results of the main companies in FMCG. Specifically, we're going to go into the foods category and the home and personal care category today. We're going out of a very interesting period in the world in the last 2 years. COVID, inflation, war in Ukraine, which has obviously affected our industry intimately. I saw a lot of results coming out a month ago, a bit more ago, so thought it could be interesting to review them and ask the experts' opinions on what's going on. So without further ado, I think I'll just ask you guys, which is a very good and very bad question at the same time. How do you see the industry? What are the general trends?
I'm happy to jump in and
jump in, Peter.
Generally speaking, across food, what we saw is growth in reported numbers around revenue, earnings per share, like-for-like sales, But as I'm sure Bryan's going to expand upon, most of that was driven by taking price. We have inflation. These manufacturers are taking price, and as a result of that, their numbers look like they're going up. If you double-click down, what you see in almost all cases around particularly staple goods, not premium, but staple brands, it's really flat to declining growth. So that there are a couple of highlights and good situations around premium brands where we actually saw growth driven by innovation. So true volume growth. But that would be my overarching preliminary assessment of the food brands. Bryan, your thoughts?
Yeah, I would probably I would agree with that, but look at it, just frame it differently, because I think the big open question that everybody's had, and that I think the big open question that's facing companies going into the back half of 23 and 24 is how much price can the consumer take, right? So what Q2 showed is that consumers are, by and large, around the world, accepting the price changes that they've seen to date. Although that acceptance is starting to slow, as everybody seems to be struggling with unit growth versus currency growth. So currency growth was pretty consistent across the board. Most of the companies that we saw earnings from at least hit their earnings targets. Some missed their sales forecast. Some missed it a little bit worse than others from a volume, who couldn't pass all the pricing through the way that they wanted to. I think, Peter, the other point that you made, which I think is a really important one, is that a lot of the actual net growth was coming from businesses either outside their sort of staple categories and new categories that they were exploring, or with new brands or with more premium solutions. And I think this is an underestimated part of the story around the world, which is that premium is working. And I think there's a real deep misunderstanding of what your strategy should look like in this sort of inflationary environment. And I think a lot of this is true specifically in the US, where the shoppers that are less impacted by inflation because their wages exceed their cost to start with are increasingly finding the premium solutions don't cost that much more than regular ones because everything got more expensive, and are shifting to premium solutions in a bunch of different ways. So I think there's a lot of meat on the bone for brands that are trying to think about not just trying to discount their way to glory. And I think these results, I think, reveal the benefits of trying to think about the problem in a bunch of different ways. What do you think, Daniel?
Yeah, no, I think it's true. I think it's very interesting, the fact that the inflation pushing up results is making companies and is making like these premium products ironically more affordable psychologically than they were, right? By the way, the couple of people in the audience, thanks for joining, by the way, said that there's some echo, so I'm gonna ask us to mute ourselves as much as we can when we're not talking. So I see that, Peter, you're on mute. So Bryan, if you can go on mute when the other person is talking, I think we should be able to solve this technical issue. So by the way, to the audience, we'll probably have time to ask some questions at the end. So if you want to answer questions, so if you have questions as the show goes on, just drop them in the comments and we can review them later. If there's something that's like very relevant to what we're talking at the moment, we may raise them instantly. Okay, yeah, guys. So sorry, go ahead.
I was going to say, happy to dig into some of these individual manufacturers. Obviously, Mondelez, their numbers were very strong. They saw net revenue increases of 17%. Their organic net revenue growth, non-GAAP related, is almost 16%, and they were able to drive up their earnings per share by a whopping 28%. So really, to the point we made, really great numbers if you're an investor, and they actually increased their quarterly dividend by 10%. So very strong numbers. The other one I wanted to call out, interestingly enough, was Coca-Cola. Coca-Cola had some decent results, but when you drill down to it, right, they saw, okay, net revenues grew 6% to $12 billion. That was nice. They saw a big bump in earnings per share, 34%, right? But when you start diving into their individual numbers, and this gets to kind of what Bryan and I said, is that worldwide their unit case volume, right, was actually down 1%. And that was driven by, the three drinks divisions. If you think about it, all suffering. Like the core carbonated soft drink business, pun intended, has been rather flat. The one sign of growth that really shone through in their results was coming from the innovation that they launched a number of years ago here in the US, as they're starting to build this out globally, which is Fairlife. This is ultra filtered milk. It's the first major innovation to the milk category, I think, since they created the cow. And as a result of that, they've been able to demand a premium price for this product that everybody thought was an already very mature commodity-based pricing mechanism. And they're doing the same now with the Costa Coffee division. So I think really great, interesting numbers, and showing that if brands focus on innovation, that there are consumers out there willing to pay a premium price for a premium product, independent of the fact that we're facing massive inflation and outside of the US recessionary periods in pockets of the world. Bryan?
You're on mute, Bryan.
That's because you put me on mute. So now Peter's on mute.
Let's. If I could do that more often, Bryan, I would.
Yeah, thanks. I think you saw some of that parallel in some of the Nestle numbers too, with the parts of Nestle that are growing. And I kind of like the businesses like Nestle and Danone that have like a more of a genuinely global footprint, because you can get kind of a feel for what's going on around the world. So if I look at Nestle, like their Starbucks division is obviously doing really well. They've got some really interesting stuff going on in pet, which was outperforming. So I think that's where you've got to read on companies that are finding areas where there's growth pockets for them and leaning in, and then also leaning in with their more premium solutions. I think the one I always find most interesting to me is Danone, just because their global footprint is probably the closest of any company I can think of to kind of how income's actually spread around the world. Like if you look at Danone's sales by geography and correlate it to where spend is in the world, Danone may correlate more closely to that than any other company on earth. So, and I like, if you look at Danone's results, the diversity of geographies that they did well in changed a lot by the different types of their product offer. So North America, they're doing very well in yogurt and water. In Europe, they actually grew really well, so kudos to them. Now they're up 6.5% on volume. They were up 9% across the board with price, but price up 8.7%, volume mix down 2.3% across the board. So Europe, they got some portfolio transformation. Latin America, they're up 11%, which is really good. And then really seeing strong growth out of North Asia and China, which is going to be a real worry for people in the back half of the year, because for global companies, China right now economically looks really uncertain. And I think, those of us that spend a lot of time looking at the US and looking at Europe, the Chinese consumer right now is not rebounding at all. And particularly in everyday categories. I think that's another market where premiumization does seem to be working, because, again, you've got a tier of people in China. You've got people that can afford premium solutions that are basically okay, but that the rest of the country is not coming back online as fast as people hoped. This is all, I guess the backdrop for all of this, too, to me, is that this kind of muddled, basically good but not perfect scenario is probably better in some ways than all out, everything's going great. Because if it's all out, everything's going great, and there's no sign of slowdown, the U.S. Federal Reserve is going to keep raising interest rates, and that's got probably more harmful effects for economic conditions and expectations than anything else. So, it's a bit of a muddle looking at all these results, but the muddle's probably good. So the problem with the muddle is that it means you can't just do one thing and do well. And I think that's one of the big learnings that companies should get out of these results is, you're going to need to be good at a multitude of things to be able to manage this sort of complicated environment.
I would add that a couple things. One, let's differentiate a muddle from a muggle, which is a Harry Potter term. But more importantly, I want to look at, you mentioned Nestle, and I think the business unit that I'm most impressed with is their Nespresso division. I think that's because they have such a strong D2C business through selling pods. And it's very interesting. I was speaking with someone this morning from their e-commerce business over in the UK. And I was commenting to them on the fact that they have built out a really interesting business unit direct to consumer. And it varies from market to market, right? In the US, because Amazon is such a huge demand aggregator, they have to be involved in that marketplace, but fundamentally different than Europe, where I see a lot of major CPGs are not engaging in Amazon because the omni-channel players in that space are much stronger, and associating with the discount value proposition of Amazon is not something that they want to do. So there's a lot of interesting things, but they've been able to grow. They have their second generation Nespresso pods in market. They're doing a lot of great volume with that, and that's a nice little piece of the business unit that gives them what I see foreseeable for the future is sustained economic growth.
And another element of what we're talking about of like going more premium, right? Because all the other coffee capsules that are compatible with Nespresso machines have become more expensive, right? So you combine the price being more similar price plus the convenience and premium proposition of Nespresso, and that probably means more people are going to the original as well.
Yeah, I would also add that there were some disappointing numbers. I would say when I look at Kraft Heinz's numbers, they grew 2.6%. When you're in a field where you see Mondelez, their former, they used to be one big happy company under the Kraft family before they split up Mondelez. Mondelez at 17%, Kraft at 2.6%, even taking price. That tells me that their numbers aren't nearly as strong, and the innovation coming out of the Kraft Heinz team is not nearly as impressive as what we see out of some other players. They have less premium brands, to be honest, within their portfolio. They have more brands that are, as Bryan said, there's a premium segment that seems to be unaffected in terms of consumers that can afford it, much like his description of what's going on in China. Kraft tends to appeal to, the vast majority of people, and those are the ones that are feeling the economic pressure. And those are the brands that often tend to be most susceptible to pressure from private label during economic downturns.
I mean, I think it's interesting, but I think Mondelez was one big mess with a lot of, it was a company that was constantly restructuring all the time. So sorry, the echo's back. So if you can mute yourselves, that would be great. Thanks. So it was a company that was constantly restructuring. And when the current CEO came in, he made a very clear bet on snacking. And he's put very strong leadership, a lot of external people actually in place. And that's been really good for them. And of course, they had a surge during the pandemic, but they were already on a good track. Whilst Kraft Heinz was already in lots of trouble, a lot of underinvested brands. Pandemic saw them do very well because of the consumption patterns during that period. I think they're going back to a certain normality. I think they're just facing the same old issues they had.
Yeah, I had a friend of mine who I will leave anonymous for the purpose, but in describing the announcement from Kraft Heinz of their new CEO, likened it to rearranging the deck chairs on a notable cruise liner that is at the bottom of the Atlantic. We'll leave it at that.
Yeah, that's the 3G component too. I mean, they brought over the guy who's the CMO of Anheuser-Busch, who's another 3G company. Now ABI is, and I'm not. This isn't a judgment on human beings, but if you look at the relative performance of ABI versus Kraft, ABI has been a much more successful company than Kraft has from a shareholder returns point of view over the last 5 years. So there's an argument that wasn't a terrible idea, but yeah, I think it'll be very interesting too, I think, as we look forward from these numbers. And, I know you guys talk to people that are in it all the time, right? I mean, Q2 wasn't that long ago, but, this is a little backwards looking now that we're in the middle of August and a lot of these quarters ended in June. My sense is that I think the quarterly reports we see next quarter may have a very different tenor to them. In terms of, I don't know that the consumer, I don't know that the story is going to be as happy next quarter as it is this one. I think this is the last time where we're going to be one. I think the brands are going to be going into Q3 are now cycling strong pricing numbers from Q3 last year. So if they even if the consumer keeps taking price, they'll be more flat versus last year than better. If that makes sense. So the narrative's going to get harder, one, and two. I do think that in a number of core categories that the party's over, and I think the party's over in two main ways. Number one, around the world, I think the consumer's running out of energy to keep this going. And I think in the U.S., the consumer's making different choices. I think there are markets in Europe where the consumer's just broke. If you look at inflation in the UK, it's now really starting to reshape how people have to spend money because that, the inflation rates in some of the countries in Europe are running way ahead of where they are in the US. So you've got that. And I think secondarily, I think in a number of markets around the world, you're going to start to see brands trying to get back to unit growth, retailers trying to get back to unit growth. I think that's going to create more of a promotional intensity to the marketplace. So, I was talking to an audience yesterday, and from a U.S. economic point of view, I described this as the Lost Rolling Stones album, Promotional Rescue. So we'll be your savior, steadfast and true. We'll come to your promotional rescue. Like Jerome Powell is going to get bailed out of trying to break inflation in the United States, basically by Walmart and by brands. Who are going to respond to a more promotional environment by doing what they do, which is to re-level set everyday pricing in a very different way. And that, I think, and you've already started to see this, basically, the net increase in the CPI in consumer goods in the U.S. has already slowed down to almost zero. And you'll see that inflation cycle, I think, break pretty quickly in the back half of the year. That's good for the economy. I just don't know how good it's going to be for the results of the companies we're looking at here. I think the U.S. is going to be a complicated market from a financial performance point of view in the back half of 2023. I think for the businesses that have more of a European bend, they may actually start to get some benefit, just because the last half of last year in Europe was awful. So you're getting to cycle some rough numbers. So if I looked at the Danones and the Nestles of the world that have more of a European footprint than, say, a Kraft, I think you'll start to see those performance gaps get exacerbated as well. And Peter, I think that's more interesting or challenging news for a business like Kraft that is probably more U.S. skewed than some of the other businesses that we're looking at.
Mm-hmm. I first of all, I want to compliment Bryan on his ability to weave the Rolling Stones into his dialogue. I always love the little side commentaries and the cultural references that he manages to embed in his dialogue.
It's important that you get really old guy cultural references in. That's the mission critical piece. So Daniel's looking at us going, "Who the bleep are the Rolling Stones?" And I can go deep on Taylor Swift references too. I'll just have to text my daughter for appropriate lyrics. So.
I prefer the Rolling Stones. If I have to give my opinion between Rolling Stones and Taylor Swift.
Taylor Swift's having a better year.
Oh yeah, she is. That's true. I mean, she should probably. Maybe next year we will be talking about like.
Can we do the Taylor Swift earnings report? That'd be good news.
Yeah, exactly. Right, we'll have to list it there. Who's the head of retail media for Taylor Swift?
But it wouldn't just be Taylor Swift. We'd have to go over the earnings results of all the travel related industries that are associated with the venues she chooses. I just read constantly reports in the New York Times and the Wall Street Journal about the increase in revenue that's being generated by her coming to town for restaurants, hotels, and transportation.
I this year have been in 5 cities that Taylor Swift has been playing in while she's been there. I can validate that personally. Between not being able to get a rental car in LA and looking at an $800 hotel room in Seattle, yes, I think the local economies are doing just dandy. So,
wow, goodness gracious! By the way, we didn't mention yet one company that actually has a Catalan CEO on the helm, which is PepsiCo. How do you read their results? Because they've done very well in the last quarters before this one. What's your thoughts? What are your thoughts on their result? I mean, they're always an interesting one because they have a very broad portfolio within the beverages, food, snacking category.
Yeah, I'm happy to jump in. I mean, they saw net revenue growth of a little over 10%. Their earnings per share was actually up 93%. So again, from the standpoint of the financial numbers, they look good, but their volume fell as higher prices for snacks and drinks hurt demand. So their volume went down, their prices went up, they took price. Fewer people actually purchased their products. And as their CEO said, every segment of the consumer is making adjustments to the new world driven by inflation, as Bryan kind of attested to. They say their volume hasn't fallen as much as they expected, and that's driven by lower unemployment than, frankly, the organization had been forecasting. And they have said that as a result, they're probably going to return to their usual pricing strategy. That means around price promotion architecture. Quaker Foods took a real big hit, and Quaker's another brand that tends to be more focused, Brian's point, on the U.S. Their volume actually shrank 5% in the second quarter, though the beverage division fell almost as much. Frito-Lay, strangely enough, they actually grew 1% in their volume. So again, you have to dig a little deeper to understand what are the components of the portfolio that are affecting. Doritos and Ruffles, double-digit revenue growth, big billion-dollar brands. They've done a lot, and this gets back to the innovation question, right? Think about, companies where they're taking core brands and they're expanding out the portfolio from Cheetos to Flaming Hot to this, to think about what, although Mars is a privately owned company, we don't have any results. Every once in a while, they throw us a nugget and talk about what their growth. You think about what the candy companies have been able to do around taking the Kit Kat bar and having 12 different flavors or 16 different varieties of Reese's, from the original peanut butter cup to every form and style you can think of. That's around innovation. What that ultimately drives is incremental growth when you add up all the equity that's going into the brand.
Well, and Daniel, I'd be curious for your take on this too, because I think one of the things that one of the narratives that came out of this was, I think Pepsi, as much as any company, was able to achieve some of its earnings objectives through pricing action in Europe. And I know that there's a lot of noise right now in the European theater of operation around why are prices still going up when commodity prices are coming down. And as the American convenience store industry always describes gas prices, they go up like a rocket and come down like a feather. And I think that's clearly what you're not used to seeing. I always do wonder the degree to which well-intentioned European regulators start to get involved with things, and then all bets are off in terms of where the world goes.
Is that an oxymoron? Well-intentioned regulator?
No. I mean, look, I'm one of the world's great optimists. I think everybody's usually trying to do a good job. I mean, well-intentioned is entirely meant. It's just that, the entire existence of Aldi and Lidl in businesses is an outcome of well-intentioned regulation to keep small stores from going out of business. So they wouldn't let big stores open near city centers. So the big stores all opened away from city centers in Germany, which created a need for small stores, which Aldi and Lidl filled because they were unregulated, because they were different types of stores. And then Aldi and Lidl put all the small stores out of business. So it's the intention of the regulator there was well intended. It's just the outcome ends up being something completely different. That one story is basically Europe in a sentence. So curious for Daniel, your thoughts on just kind of where you see where you see Europe. And Europe's obviously not a monolith, but certainly from an EU point of view, what are some of the discussions people are having around the landscape, how that's unfolding, and how people are thinking about the EU as a whole versus market by market?
Look, I think that in Europe in general, things for the good and the bad, they go slower, right? So since it's a more highly regulated market, it's a less uniform market like the States. So, for example, when there's a period of economic downfall, it falls slower than the US, but then the recovery is slower as well, right? So, ironically, inflation, I think, was as high as it was in the US, so they weren't able to stop it for all the regulation they tried to put in it. And I think that the market is just taking longer to readapt to the reality, as you said, lower commodity prices as they were. I think there's also a sense in some way of like, well, if consumers are willing to pay for it, we'll keep the prices there. Well, there is not a need to lower them if people are still buying, if that makes any sense. I think it's as simple as that, really. Do you guys want to? Well, I want to invite you guys to turn a page and then go into the food, and then out of food and then into home and personal care. But we're actually going to go into a company which is probably the last of the multinationals that you could basically survive off their products, which is Unilever, because you can clean your house, you can clean yourself, you can eat with their product. I don't know how long you would survive or how healthy you would be after eating ice creams and soups and mayonnaise for some months. But interesting to know what your thoughts are on Unilever, which obviously has just welcomed the new CEO, which I think was a bit of a surprise appointment as well, coming from Friesland Campina, which is a Dutch dairy co-op. Maybe people were expecting an internal candidate, or maybe somebody coming from a larger, maybe more global business. That would have been at least my personal guess. And obviously, they've gone into a bit of a strange mode. Unilever has since, well, they were already in a bit of a strange period, but then they tried to acquire GSK's consumer healthcare business, which is now Haleon, failed at that, and then basically split up their business into business units, which obviously raises everyone's question about what business unit are they going to sell. So with that, what are your thoughts on Unilever?
Bryan, you want to take first shot
Yeah,
at this?
it's a complicated one.
Yeah, I think the Unilever means complicated in the original Latin, so we can just kind of roll with that. I think from a new CEO point of view, I think given the number of ex-Unilever people that work at Friesland Campina, it's probably not as external a hire as it looks. So businesses have a fair amount of people sharing history. I think right now, if you look at a couple of things in here, look, I think Unilever's numbers are always mixed, just because, to your point, their portfolio is so complex. I don't think there's ever anything sort of uniform in their business. To be honest, they are. They are definitely, like everybody. I think some of the themes here are pretty consistent, which is that you've got pricing, which consumers are taking. You've got units which are challenged. I think the one thing that was interesting that came out is that Unilever said that the 41%, I think, of their businesses are winning market share, and which means that 59% are not, obviously, that they're either flat or losing. And I do think that I think that's probably going to be a main area of focus for them going forward, is trying to figure out how to get a little bit more price competitive. I think when you look at where Unilever sits in categories, their positioning will vary wildly by country in terms of where their brands come into the marketplace and where they sit in categories. So whereas with P&G, whose numbers were, I think, overall a little bit more coherent, a little stronger, not to value judge again, but yeah, P&G's got everybody has a simpler portfolio than Unilever. They have a slightly simpler portfolio and a slightly more traditional go-to-market kind of foundation. And I think P&G's numbers across the board were a little easier to read as a result. I do think that I think Unilever's got a wide range of issues around the world in categories, and obviously continuing to try to figure out what their portfolio needs to look like. Peter, Daniel, to your point, they're looking to expand their portfolio in some areas through acquisition. They continue to rationalize brands, like selling off Suave. This is a business that's going on a journey right now. I think bringing an outside CEO is an interesting one for them. That somebody who can just take a fresh look at the portfolio and say, hey, look, what are we trying to do here? Probably isn't the world's worst thing. But yeah, I thought their numbers were a mixed bag of stuff, to be totally honest. And as I said, that one piece around everybody's taking price, but when you measure it in terms of where we're gaining share versus our competitors, you can get a little bit worried about what's happening competitively. I also think that in general, sweeping generalization time, the health and personal care side of the world is a little bit more innovation centric, and has a much wider range of competitors than the food business does. So I think in the food business, you're often likely to have 80 or 90% of the business going through 3 or 4 big companies. You'll have innovation at the margins, but a lot of categories are still core. I think your competitive dynamic in non-food, I think, often varies a lot more, and you've got a lot more small, local, natural, innovative, whatever it is. So I think the competitive dynamics is a little harder to read, Peter. I'm not sure what you think about that, but.
Well, before we get to that, in a nod to the need for breaking news, as we were sitting here and you were expanding on that, Bryan, the announcement went out from Progressive Grocer that Aldi had acquired Winn-Dixie from Southeastern Grocers. I'm going to rank that right up there with the new Kellogg's innovation of brunch in a jar, the Eggo's Sippin' Cream. But let me get back to, I don't know if you have any comment on that, Bryan.
I do actually. That's actually not that. That's a really big deal. So just there's two immediate things that come out of that. Number one, that's going to have a really interesting impact. If you took the Winn-Dixie stores in Florida and turned them into Aldi stores, that's got a really interesting price. That's got that may be one of the better things that's ever happened to Florida shoppers from a pricing perspective. Because
what are they going to do with the other 3/4 of the store size of the Winn-Dixie store if they move into an Aldi format?
Well, it'll be
a lot of extra real estate.
Well, yeah, I mean, it'll be interesting to see. I mean, you could certainly lease the space out. Aldi does a nice job. I mean, you can find an Aldi store just about anywhere. You can find an Aldi store in some Kohl's, for God's sake.
I think about when CVS acquired Long's and they had stores on the West Coast with bait and fishing tackle. They didn't quite know how to manage it. But yeah, I agree with you. I think it's interesting. My question is, what's the raison d'etre of Southeastern Grocers without their flagship brand of Winn-Dixie?
I think you could have
the demise.
I think you could have asked that question 20 minutes ago, and probably you could have probably asked the same question. Yeah, I mean, I think that business was that business is clearly looking to monetize the assets that they've got, however they're going to choose to monetize them. I think the number of retailers around the world that have underestimated Aldi's ability to adapt to a market is long, and their history is not good. So they are arguably the smartest retail business on the planet. I meant to just have a quip about this, about breaking news, and there you go. You get some.
Let me bring it back to Unilever. I think that what they've done is, to your point, we've talked a lot about where there's growth in premiumization and there is decline in more commoditized products, right? They sold Suave. They bought like Yasso, the premium yogurt business. I think they are trying to align to this new world where they understand that if they want long-term growth in brand equity, they've got to find ways to have more premium, more innovative products in their portfolio. So I think that from that perspective, Unilever is moving in the right direction. The question is, how long is it going to take them to get there, and how will they refocus a lot of their core products? They're one of the few CPG companies of any note that still is on both sides of the equation: food and beverage consumables and health and beauty care. Procter & Gamble long ago jettisoned all their old brands. People don't remember, but they were the ones that invented Pringles, Folgers coffee. There were a lot of other brands in there, and they've decided, no, we're going to focus on one side of this equation. Unilever is still trying to play both sides, and the question is, are they going to be able to do that successfully? I don't necessarily have the answer, but those would be my thoughts on Unilever, Daniel.
Is it this, for me, this general feeling that it's not like they want to play both sides of the table, but they've just found themselves playing at both sides of the table, and they've been like deciding what they want to be for a bit too long.
Bryan?
Yeah, I think that's Daniel. I think your point's dead on. You just kind of, their portfolio is more sort of evolved than been designed. So yeah, I think that makes sense. The challenge is, and I think this is one of the interesting things with all of these companies that you look at. I mean, look, I love the team at Yasso. I love their product. I have some in my freezer, right? But if you're going to try to steer Unilever by buying Yasso, that's like being on the Titanic and sticking a canoe paddle in and trying to turn the boat. That's just you're going to need a lot more paddles or a lot bigger. You're going to need a lot more rowers or a lot bigger paddle. And that's where I love
buy more Cherry Garcia.
Exactly.
I can get those references in too.
Yeah, there you go. So yeah. Why can't you do it? Why can't you set your chunky monkey free?
This was supposed to be a serious conversation, guys.
The point.
Wait, you invited the CPG guys. You did not invite serious thought leaders. Come on, you knew what you were getting, Daniel.
You got the wrong guys.
I presented you guys as industry experts.
No, okay. Again, that was artificial billing. You'll have to rethink that next time.
I think that the history, and if you look at how Unilever continues to architect some of these acquisitions, where they are now really trying to leave these brands kind of to run so they can learn stuff from them, I think that's actually the interesting thing. The interesting thing to me is not Unilever buying Yasso. It's what does Unilever buy? To your point, what does Unilever learn buying Yasso that they can apply to Ben & Jerry's, which is a scaled business within their portfolio that can then help them genuinely move the needle. I do think that these, in kind of the way, because what you need to do if you're one of these big CPG companies is you either need to do a lot of these acquisitions in a row, where you actually then fundamentally change your portfolio, or you just need to get better at learning what it is, learning the skills that you're acquiring and then reapplying them. So,
by the way, just a reminder to our audience, speaking with PBSB and Bryan Gildenberg from the CPG Guys about the latest results of consumer goods companies in food and beverage and personal home care. I'm trying to keep it serious, and they're derailing me a bit, but we're getting along. We're going along. You were mentioning Procter & Gamble before, which, I mean, for me, it's like, thank God that not all companies are like that, because as a headhunter, I'd be out of business. Like, they only hire internally.
Well, they only promote internally. I can think of a handful of people I know when emerging technologies and capabilities developed that they couldn't simply recruit from inside because they didn't have expertise. I think about loyalty and CRM. A handful of my friends from my days at dunnhumby made their way in to Procter & Gamble. But to your point, particularly in the sales organization and the brand marketing organization, all homegrown. You come in through right out of college, or you don't come in the door. Is the rule more than the exception at P&G?
Absolutely. I mean, I know this one guy that joined P&G at band 6 from Reckitt.
Yeah, but their numbers are interesting. They had 5% growth, which, given all the price that's been taken, not terribly impressive. If you look at it, their beauty segment was growing at 11%. So that means some of their other categories and divisions not doing nearly as well. I'm honestly kind of surprised, and they've been pretty clear that, the organic sales in hair care have really only been in the single digits, primarily due to pricing increases. I think for a company that is renowned for its innovation, driving growth, I'm not feeling the love in these quarterly results. I'll pass on to Bryan. I'm sure he's got some poignant thoughts on P&G's performance.
You're on mute, Bryan.
Well,
there you
you're
go.
The one that mutes me, so I always expect you're going to be the one that unmutes me. So,
sorry about that.
No worries. No problem. So, I'm just having
Oh, he's frozen. We'll let him. I'm sure he'll be back shortly. There he is. Bryan, you there?
I thought he had a water problem and not an internet problem.
I know. Who knows?
He'll be back. He'll be back.
But no, I mean, listen, Procter's a powerful organization, and they drive a lot of the activity that's going on in the industry. Everybody looks to them, and so many other companies feed their organizations with professionals that have moved their way up through the organization. That's usually what we see, is they become a feeder ground. I'll pass it. Bryan, I don't know if you're back and are able to talk yet, but I see your internet's a little slow. We'll give him a second, but Procter & Gamble tends to be the building ground for so many leaders in our industry, and they feed people over. And to see them with numbers that are not nearly as comparable to what we're seeing competitors across fast food and consumer goods is, I don't know, surprising at a minimum.
Don't you think there's an element as well that they actually did super well in the last 2 or 3 years, and that it's like just a bit hard to keep up with how well they did? Or,
well, I think if anyone could demand price, it's Procter and Gamble. You know, the challenge has been over the last couple of years, the lack of, you know, when people were dealing with production constraints because of the supply chain during the pandemic, the need to do deep discounting promotion was negated, because you did one of two things as a brand if you didn't have the ability to produce according to the demand. You either rationalized your assortment and just focused on the core items, or you got in the business of doing allotment, which is you decide that I'm going to fill this retailer at 100% of their demand. I think we know who that retailer is. And then you get down, and when you went to a regional player, like I shop at a very regional retailer in my area where I live in Guilford, Connecticut, I saw massive out of stocks during the pandemic, right? And that was because they were at the low end of the allotment chain. And that's why you start to see a whole lot of retailers talking about either full-on acquisition and merging, or creating an alliance with super regional retailers so that they can act effectively as an individual buying unit. Procter and Gamble, you know, they had what I would consider, given the price that everybody else is taking, given the price that they've taken, to come back with 5% growth numbers. I don't know if that necessarily would dazzle me in terms of the direction they're going. Do I have the ultimate faith that Procter and Gamble is going to get their act together? They always do. They always do. Like I don't bet against Procter and Gamble. I'm not saying that. I'm just saying this is one of the quarters where I say, I guess this is a blip, and we'll have to see if a blip turns into a trend. I don't think it will, but right now it's a blip.
Yeah. Along similar lines, you have Reckitt Benckiser. Well, now branded as Reckitt.
The artist formerly known as RB or Red. First they were going to split up. Then they decided, no, let's stay together for the kids. I know. I'm just joking. But, you know, Reckitt, you know, they had, again, their Q2 numbers were only 2% increase. So that not quite as good as Procter and Gamble. They would argue that that when you look at it across the first half of the year, they grew 8%. But if you look at the most recent quarter, it was not nearly as impressive as building that into the first half results. You know, the like-for-like sales growth of 6% in first half was pretty strong. And but I think they're probably showing signs, particularly as they tend to be a little more focused on the European market than here in the United States, that they're probably feeling the pressures of the economic downturn in the European markets. So I would say that you know, health and here's the reality of the situation. And let me talk about this from the U.S. perspective, right? Mm-hmm. What happened in the United States is during the pandemic, the Supplemental Nutrition Assistance Program, it's known as SNAP. Some people know it formally by its name, food stamps. These are the government subsidizations of purchasing. Emergency provisions went into effect that were terminated in March of this year. What's happened as a result of that? We've seen a radical reshift of purchasing behavior for consumers. It's most pronounced in non-food consumables. So everything outside of food and beverage. Did food and beverage take a hit in terms of people who panel companies like Nielsen and IRI, or the artist formerly known as IRI, now known as Circana report? Yeah, they did. Food and beverage saw declines among SNAP households of upwards of 40%. But when you look at their non-food purchases, it was twice as big of a decline. So it's an 80% drop. So people, if you look at what happens, is that people adjusted their baskets, right? They said, okay, I don't have as much money to spend. I still need to eat and live. Maybe I wash my hair every other day. I don't need to wash it every day. People make rational decisions to keep food in their stomach and keep their family alive. Reckitt's a non-food company like Procter & Gamble. Consumers are starting to make rational decisions, and the Q2 numbers, and here's Mr. Gildenberg, Bryan, I was just saying that there are some rationalizations that people are taking in the wake of the ending of the SNAP emergency benefits at the end of Q1. And I think if you break down like Reckitt's numbers and you look at Q2 versus Q1 of their numbers, they're a great example of a company that I think is probably feeling the pressures of people making rational decisions about reallocating money that they might have been spending on non-food consumables and focusing that on food to the detriment of the brands that companies like Reckitt and Procter & Gamble are selling.
Well, I think that's particularly acute for a business like Reckitt, which skews very heavily towards baby care in the U.S. because so much of the baby care in the U.S. is bought through government assistance. Like over half of that category is paid for by SNAP. So that's that makes sense actually. In terms of if you're going to try to isolate the experience of a business that's going through that specific change, Reckitt would be the one to look at.
Yeah. I think it was the CFO of Reckitt that pointed towards the growth of private label. I just wanted to ask you guys on that point because we haven't mentioned it. And what do you think of private label in all this context?
I'll take that one to start, Peter, just because I've been off camera for all, I guess. Apologies. My computer and StreamYard seem to have agreed to disagree on whether they're going to work. I think there's a couple of things that are important to remember with private label. Number one, the supply chain disruption that we've all experienced in the 2 years prior to the last year. Supply chain disruptions, other things being equal, will hurt private label companies more than branded ones because a private label company is trying to solve a more complicated supply chain problem than a branded one because they've got to take the same SKU and make it 20 different ways. So other things being equal, a private label manufacturer will get more disrupted by supply chain than less, which is one of the reasons why private label share, even in the economic turmoil leading into high inflation in mid-2022, private label kind of lost share a lot because it couldn't get on the shelf any better than branded could, and often worse.
And Bryan, that differentiates from like 2008 when we saw the economic downturn. There wasn't a supply chain disruption, and private label was actually able to make bigger gains during that downturn than this one that was driven a lot by the supply chain disruptions. Yes.
Exactly. Yes. Yeah. That's exactly right. So now that you've got the supply chain more normalized, though not perfect, but more normalized, and now you've got a more stable, like a higher pricing environment, I do think you're starting to see retailers starting to lean in on the private label side. And I think this is going to be one of those things that's going to be a bigger story in Q3 and Q4 than it was in Q2. Because I do think that shoppers don't buy private label all of a sudden. Usually they kind of, like if everything's changing and all that stuff, the shopper's not likely to go, boom, I'm going to switch to private label because it's a leap if I wasn't buying private label in that category before. So, if you're in the middle of an earthquake, you don't try to jump 20 feet, you just try to get to the next safe spot, right? Once the world stops shaking so much, that's when I'm like, you know what? I need to recalibrate my grocery budget now, or my health and beauty budget now, or the thing that I love costs 25% more than I used to, so I'm still going to buy that, but I don't have 25% more money. How am I going to afford it? I think in the sort of rational calculus that follows disruption, private label, I think, can do extraordinarily well as people start to recalibrate, and as the retailers around the world have a wide range of approaches to private label. Yep. Some of which are very bare bones and everyday, some of which are like the aforementioned Aldi, who are taking a very different look at that. But I think you've got a window of opportunity right now for retailers to rethink private label in a really interesting way. And I think coming out of the NACDS Total Store Expo, where I was just at prior to this, literally prior to this morning, one of the big topics of conversations between brands and retailers was what's the right role for category management in a broader category conversation. And I think brands are starting to understand that I can't just wish private label away, but that I've really got to figure out how to make it work.
Yeah. And to add on that, there are a whole lot of categories where not only can you not wish private label away, they are the dominant player. I think about categories like adult incontinence, where private label can be 60, 65, 70% of the volume. The challenge for them is always, they're never going to be your category manager. They're not going to bring the category expertise. The manufacturer is selling you a product absent the marketing costs built into the cost of goods. And so it's kind of up to the retailer. So there's always going to be a role for the brand. The interesting part for private label is now that the supply chain issues have been resolved and they have a wide array of choices to create, identify manufacturers to help expand out their private label. The digitization of the store is going to power private label because it is connecting with consumers and giving them what they need to get over the hurdle of whether to try private label. And what that is informed content. The single biggest driver of conversion from national brands to private label is positive customer reviews, because the biggest obstacle to people trying private label is not price. Price is built into the equation. It is truly the quality of the product. And when manufacturer or retailers are able to solicit from their users and present back to their shoppers positive reviews of their product, saying that this is as good or better than national brands, the value proposition to so many consumers of getting feedback from other people who they don't know but have tried the product and say, yeah, it's really good, I give it a try, that's enough for them to try. And the problem is, once a consumer has tried private label, if it does meet or exceed those expectations around quality, you may well have lost that consumer to the private label brand. It's very hard for a national brand to get back a consumer from private label if the quality of the private label matches or exceeds the national brand. Why pay more for a product that is equal or less inferior to a brand I can get for less money?
Yeah, that's interesting when you talk about reviews, because that's something that I think also is overlooked a lot of times in consumer goods and has a lot of potential, no? Because obviously we use.
I mean, when you walk into a store, when you walk onto the digital shelf and you see national brand private label, and the private label's got 1,500 reviews with a 4.6 star rating, and it's labeled as, top rated product. If it's a low value consumer good, right there on the listing page, not even on the product display page, right on the listing page, clicking and saying, yeah, add that to my basket, that's a pretty easy decision to make. And now increasingly you're starting to see retailers understanding the influence that user-generated content can make. You start seeing it appearing on shelf tags, either in the form of extended shelf tags that may have a written review, but increasingly you see retailers like Amazon Fresh put on their digital shelf tags the average star rating and the number of reviews as a cue to tell consumers what other consumers think of those products, and that's enough to drive conversion at the shelf. So there is an impact, and national brands should be concerned about the proliferation of user-generated content, particularly around private label. The more retailers figure out that this is their recipe to drive conversion, the higher their margins are going to be on selling their brands, because they'll be moving people. Yeah, their revenue will take a hit, but their margins will see tremendous improvement if they can convert consumers to private label products.
One, I think this has got to be one of the things that, and this is a global thing as well, because I think a lot of the commentary that you're getting from these two folks with an American twang to them is a very U.S. centric look at private label, because I think around the world it obviously plays a very different role in markets, in markets like the UK and Germany. But I think across the board, the thing that's going to be important as the ecosystem becomes more promotional in most markets where people are, you're going to start to see that the price reference point between the brand and private label gets reframed. The ability to kind of understand elasticities a little bit more dynamically and a little bit less statically is going to be really important for brands over the next whatever, right? I think what you're going to learn about how to get this done is going to be critical to how you manage price elasticity in a future where pricing is just a lot more dynamic. So whatever the skills are and tools are and analytic capabilities that you've got, where you're able to treat price elasticity a little bit more like an A/B test and a little bit less like some giant study you pay McKinsey to do and then you use it for 3 years, I think is a very big deal. So I think the ability to dynamically understand where your price as a brand sits versus private label or other important competitors will be critical.
Hey guys, well, we're hitting the hour. I know that you guys have a ton of things to do. I have a few things as well here and there. We can leave it at this. Great to have you guys. I mean, as always, it's a delight to chat with you and learn, and a lot actually learn from
Daniel,
you.
it's 5 p.m. in Barcelona. I know exactly what you're about to do, so you should get
You'd be surprised. Bryan. But thanks a lot for joining me. We did leave a couple of things to talk about, but it's always a better thing to leave the conversation.
You never know what you're going to get with the CPG guys.
Exactly.
And we're big fans of the FMCG guys. You guys are doing great work across the pond. We're so glad to be associated with the FMCG guys enterprise.
Yeah, keep it up, guys.
All right.
We're doing our best. Thanks a lot, guys, and see you soon. And thanks to the audience for joining. Cheers.